When you clicked on this video, you might have looked at the title and then looked at the channel name and thought to yourself, why is a channel about trading and investing talking about bacon? Let me explain. I was recently checking the financial news when I came across an article from Bloomberg explaining how people around the world were paying extortionate amounts for bacon, as pork had gone through the steepest rise in global prices in 15 years. Prices in China had jumped by well over 100% in just 1 year. This gave me flashbacks of the movie Trading Places, where the traders in the film are focused on trading pork bellies.
My God, look at it!
Now, as a modern trader, you don't tend to get too involved in trading the agricultural commodity markets, but there's something very appealing about them. They're sort of romanticized in my mind. I decided to explore further, and the more I discovered, the more I found myself going down and down into the rabbit hole. What I found was a perfect example of how interrelated financial markets and economics can be, and how this one thread of pork prices so heavily affects the world around us and offers the most unexpected investing opportunities. I want you to come down the rabbit hole with me as I share with you what my team and I found. There are three key areas we need to understand. The global tug of war that's adding pressure to the situation, such as the trade war between the US and China. The hog apocalypse that's spreading around the world at a frightening pace, decimating hundreds of millions of pigs. And to grasp the importance of both of these points, we first need to figure out the typical production process. In other words, what happens in normal times? When you talk about the production of a man-made product, it's normal to think about the inputs and the outputs, the supply chain, demand, and so on. But what I find quite strange is how livestock is also described in a similar way. A little while ago, we put out a video about the life and career of Ray Dalio, the famous hedge fund manager and founder of Bridgewater Associates. There was a story that stuck with me about Dalio and the McDonald's chicken McNugget. Dalio thought about the cause effect and realised that the chicken could be seen as a simple machine consisting of a chick and its feed. So the main and most volatile cost the chicken producer needed to think about was the price of chicken feed. Dalio showed Lane Processing how to use corn and soy futures to lock in their costs. This way they were able to fix their prices, which then made the chicken more affordable for McDonald's. This meant they were able to go ahead and release the chicken McNugget, all thanks to Ray Dalio. So I thought if we think about pigs in a similar way, we can understand the inputs and outputs which will help direct our research. This means, just like any other product, we need to understand the production process. There are broadly 5 stages to hog production: reproduction, birth and gestation, feeding, finishing, and packing. Now, we're not looking to start breeding pigs, or at least I'm not, so it's not necessarily important to understand absolutely everything. We just need to know the important variables that tend to affect prices. And side note, there is actually a technical difference between the term pig and hog, but we'll be using those terms interchangeably because, well, you know. If you want to produce a pig, reproduction is essential. Facts. The amount of breeding that happens is going to determine how many pigs are born. A pig birth is also known as a farrowing, so you learn something new every day. The more farrowings there are, the more supply there will be in the market. So, keeping an eye on reproduction is important for understanding price shifts. That also means you need to monitor factors that may affect reproduction. In particular, weather is an important one and causes some seasonality in reproduction numbers. When the weather is very hot, hogs become more inactive and won't be in prime condition for breeding. Whereas when the weather is relatively cold and there's a good supply of freshly harvested corn, the breeding conditions are pretty good. So the best breeding conditions are typically from November to January, leading to the largest number of farrowings taking place between March and May, while seasonally low numbers will happen between December and February. At this point, you might be doing your mental maths. If November to January are the best breeding conditions, and the largest number of farrowings are happening between March and May, yes, that's right, the gestation period is just 4 months. This is great news for producers because it means hogs can breed twice a year, ensuring a steady flow of pigs. The average litter size is 9 to 10 pigs, although this can vary depending on a range of different factors. In fact, the number of pigs in a litter has actually increased in recent years thanks to improvements in health, production methods, and genetics. We would need to take into account yield figures to understand the future supply of hogs coming to the market. This is also going to help us determine the demand for food during the next phase, the feeding phase. After weaning ends, which is usually around 3 to 4 weeks, the main ingredients in pig diets are corn and soybeans in the form of soybean meal. Their diet is also likely to include barley, oats, distillers grains and wheat, as well as other supplements like oilseed and vitamins, confirming that pigs have probably watched the Game Changers documentary. Feed represents around 70% of the production cost of pigs. Around 1,000 pounds of feed will produce a 240 to 270 pound hog. This leads to a two-way relationship which we need to consider. If the prices of feed increase, it's going to make the production of pigs more expensive. This means producers may look to substitute products if it's only certain grains that are pricey. Or if feed in general is expensive, then farmers may take their hogs to market much younger to avoid incurring more costs. This means the weight per hog will be lower, but the number of hogs coming to market will be higher. On the other hand, if there are fewer pig farrowings, there will be less demand for feed, which would cause the prices of feed to fall. With this in mind, livestock feed, such as corn, which is the most commonly used feed in the US, will typically have an inverse price relationship with lean hogs, and many farmers will hedge their exposure to corn prices. So, we need to understand the factors that may affect feed prices, and we may also want to look at the grain markets for more investing opportunities. During this feeding phase, a certain percentage of the pigs will die from things like suffocation, disease, and weather. This attrition number is usually around 5%, and any major fluctuations in this figure will affect the supply in the next phase, which is the finishing phase. It takes around 6 months to raise a pig from birth to be ready for slaughter, so it's really not a long time at all after reproduction that a hog is ready to be sold. Producers will usually sell the pigs to packers for the final stage in the process, which is the packing stage. A 270 pound hog will yield a 200 pound carcass. This will, on average, produce 25% ham, 25% loin, 16% belly, 11% picnic, 5% spare ribs, and 10% butt. What we've discussed so far is what contributes to the supply side of the market. This is just one half of what will affect the prices of lean hogs, which is the commodity that you'd be trading to get exposure to the entire process. Gone are the trading places days of trading pork bellies.
I have a hunch something very exciting is going to happen in the pork belly market this morning.
But of course, the price is not going to be determined by supply on its own. We also need to consider the demand relationship. Just like with the supply side of the equation, the demand for pork is also going to have a knock-on effect on other industries and products. This means, in the same way that there were potential opportunities based on supply, such as with livestock feed like corn, we can find similar things based on the levels of demand for pork. And there are some huge opportunities right now, more than ever, as you'll find out in a moment. So here are some things that we're going to want to consider if we want to find opportunities to profit from. If we want to know how a particular segment of the market's demand is going to affect the price of pork, we need to know the quantity demanded and the price elasticity of demand. In other words, as the price of pork increases or decreases, how much does that affect the quantity being demanded? Part of that price elasticity is going to depend on the availability and desirability of substitute products. For example, on the food side, this might be things like chicken or beef.
Chicken!
Now, you might be thinking, yeah, thanks for the basic economics lesson, but it's for good reason, because this relationship can lead to some really good trading opportunities. You see, some uses for pigs might not have a substitute. That means for those specific uses, the quantity demanded will remain relatively the same. This might present opportunities for us in those specific industries that will be directly affected if the price of hogs changes. So let's start with the meat industry. This is the number one use of hogs and it's a huge market. That means the hog farming industry clearly depends on it, and any reductions in demand from that sector will severely impact lean hog prices and the production companies themselves. So I think it's fair to say they're not the biggest fans of vegans.
When I shook his hand, I could feel the suffering that those animals have had to endure.
Although the topic of vegans raises an interesting point. Rather than calling it the meat industry, we can look at this as the global protein industry. And with that in mind, it's not entirely dependent on piggies, because there are many different substitute products, from beef to chicken to fish to those slices of meat that look like a duck, taste like a duck, but are actually things I can't pronounce. So consumers might not get to enjoy a bacon sarnie, but they're not going to go without protein just because there isn't enough supply of pigs or because prices have skyrocketed.
I'm gonna eat the bacon Big Mac with Big Mac bacon. Without any bacon, it's going in.
And this is something really important to keep in mind. If prices increase too much and these price increases are being passed on to consumers, they're very likely to look elsewhere. However, you may not be aware that pigs are also critical for some pharmaceutical and industrial products, and this is a big business. For example, the pituitary gland of the pig is used in medical products, and on a price per weight basis is the most valuable part of the pig. Or take the blood thinning drug heparin, for example, which is made from pig intestines. The pork industry doesn't depend on the pharmaceutical industry, but parts of the pharmaceutical industry definitely do depend on pigs, since there's a lack of substitute products for certain things that are needed. So, if hog prices rise, this presents an issue for pharmaceutical companies that rely on it. If there's no substitute products available, they'll need to incur the costs. And if there's a limited supply, due to factors that we discussed in the production process, the pharmaceutical companies are going to be driving up the prices. This is because pharma companies incur heavy penalties for late delivery of products, so they'll be willing to pay a lot more to get their hands on the limited supply. In a nutshell, high prices for pigs is likely to lead to a reduction in demand for pork as a meat, which may affect producers negatively, and is going to lead to higher costs for pharmaceutical companies that depend on it, therefore having a negative impact on them as well, and vice versa if prices are lower. So, other than the variables in the production process itself, what else can lead to these big shifts in supply and demand? Well, since the protein industry is truly global, the most common cause is geopolitical factors. This is like a constant tug of war around the world, and specifically, the recent trade war between the US and China has been huge. China is far ahead as the world's largest consumer of pork products. 60% of the meat consumed in China comes from pigs, which counts for about half of the world's pork supply. They're also by far the largest producer of pork in the world. In recent years, they produced around 50 million metric tons of pork per year, which is over double the amount of the next largest producer, the European Union, which produces between 20 and 25 million. Something I find fascinating is that China is home to around 40 million pig farmers. That's around the same number of people as the entire population of Spain. That's a stat that makes you think, oh, come on, that can't be true, can it? This level of production and consumption has actually left very little for China to export or need to import. That is, up until the disasters that have taken place this year, which we'll come on to in just a moment. So, world exports from China in 2017 were just 3%. But, as you may imagine, any disruptions to this balance in supply and demand in China, and there will be huge knock-on effects around the world, affecting the entire global protein industry. You also have the indirect knock-on effects. For example, the impact on the pharmaceuticals industry, the demand for pig feed and how this affects the prices of grain and the success of grain producers. In short, China's demand for pork affects many industries around the world. This is why it's being reported that US pig farmers are being crushed by the current trade war between the US and China. You see, if China isn't able to satisfy its demand for pork, they'll have to look overseas and import it. And typically, farmers from the US would be able to step in and help to fill that gap. But since China have slapped a 72% duty on US pork, American products have become too expensive to import. Instead, these US producers are losing out to their Brazilian and German counterparts. Now, this might not seem like a big deal normally, but imagine if there was a 5% drop in Chinese supply, that supply that needs to be filled from elsewhere. That's a huge boost to the pork industry outside of China. What if instead of just 5%, which might not seem so significant to you, instead, let's say the supply in China dropped by a massive 50%. This wouldn't just be a boost for global pork around the world, but it would be a boost in demand for the entire global protein industry. Some producers would be having their greatest year ever. But 50% sounds unrealistic, right? Kind of crazy. Well, what if I told you that's exactly what has happened? It's estimated that around half of China's pig population have died or been culled so far this year. The actual amount is expected to be even larger, but official statistics in China have been unreliable so far. The cause of this huge catastrophe that's being dubbed as the hog apocalypse is ASF, African swine fever. Imagine there was a virus spreading amongst humans. The mortality rate was close to 100%, meaning that if you catch this virus, it's almost certain you're going to die. And that's going to happen rapidly, between 2 to 10 days. That sounds like something out of a horror movie, doesn't it? Well, this describes the terrible virus that's wiping out hogs across China and is now spreading to other countries as well. The ASF virus is a DNA virus that causes a hemorrhagic disease in pigs, warthogs, wild boar, and wild pigs. The symptoms include high fever, loss of appetite, and hemorrhages in the skin and internal organs. This disease is about as catastrophic as you can possibly imagine. The World Organization for Animal Health has reported that the death rates from ASF may be as high as 100%, and death can occur as quickly as between 2 to 10 days. What makes this even more troublesome is that as yet, there is no vaccine for the virus. Fortunately for us, there is no health risk for humans, but we can carry the disease, for example on our clothing, which is helping it to become even more widespread. Now, you may remember various foot and mouth outbreaks around the world. Well, a veterinarian has described the current situation by saying, foot and mouth disease is like a wildfire, and African swine fever is like a lava flow. It doesn't go as fast, but it scours whatever it hits. Unfortunately, part of the massive impact on China's pig population has been due to their ineffective control efforts. As a result, this has even been spreading outside the country, impacting Vietnam, the Philippines, South Korea, and recently it has been reported to potentially have entered Europe through Russia. The first outbreak of ASF happened in 1907, so it's not a new disease. However, it's mainly been restricted to Africa, with occasional occurrences in Europe, such as in Spain and Portugal, which was then eradicated through a slaughter policy. It was in August 2018 that it was first reported to have hit China. In a way, it was partly due to market prices that the virus has been able to spread so rapidly. The Chinese government tried to contain the virus by blocking the transport of live pigs and pig products throughout the country to avoid it spreading beyond the 6 provinces where the disease had been confirmed. This ban in certain locations led to price differentials between different provinces. This encouraged pig producers to find underground methods of transporting and selling their pigs in more profitable provinces. As a result of this, by the end of 2018, the outbreaks had spread across 23 provinces and municipalities in China, and by April 2019, it was confirmed in every region. In early 2019, Chinese average live hog prices actually dropped as more farmers began taking hogs to market, therefore increasing the quantity of supply. Since they knew there was a good chance that the animals would get, or were already, sick, they would need to consume or lose their pigs. This also includes the pigs that would be ready for breeding, which means that there would be a shortage of pig production later in the year, as there would be fewer farrowings taking place. Although there is little to no human health risk, there has still been a significant drop in demand for pork in China. This includes anecdotal evidence of restaurants completely taking pork off their menus since customers just aren't buying it. There's a history of Chinese consumers being fooled by companies and the government in the past when it comes to these sorts of risks, so consumers are understandably wary. This means there are 2 impacts for the global protein market. Firstly, there's a lower supply of hogs in China, which means the demand for pork must be met through imports. However, there's also a shift in demand from pork to other substitute products, meaning there will also be a boost in demand for other proteins. Now, although demand for pork has declined in China, supply is clearly declining at a faster rate, and therefore prices in China have skyrocketed. The Chinese government attempted to stabilize prices by releasing pork from their emergency pork reserves, but it's still not enough to contain this problem. Over in the US, American pig producers have been increasing their supply in anticipation of being able to satisfy the Chinese demand. However, since the trade war is still causing restrictions, this supply isn't going anywhere. As a result, US prices have remained very low. So there's a clear discrepancy between the US prices and the Chinese prices. Although it's not possible to benefit from any sort of spread trade between these 2 different prices, since there's no futures market for Chinese hog prices. Instead, we need to find our opportunities from elsewhere, by going back to what we know about the production process and thinking about what the cause-effect relationships will be there. But before that, there's an important topic that we have to cover. When it comes to investing and trading, there's often a debate around what is or isn't ethical. Sometimes, the biggest movements in prices can come from natural disasters, wars, and terrible events that ruin lives in huge numbers.
I will tell you, and every trader will tell you, who was not in that building and who was buying gold and who owned gold and silver, that when it happened, the first thing you thought about was, well, how much is gold up? The first thing that came to mind was, my God, gold must be exploding. Fortunately for us, all our clients were in gold. So when it went up, they all doubled their money. Everybody doubled their money. It was a blessing in disguise.
Some people see no issue with profiting from this, while others find it a bit callous to make money from the suffering of others. In the case of hogs, that ethics issue is twofold. Firstly, you have the production of pigs itself. Now, I don't want to start sounding like PETA, but it's quite easy when you learn about the production of pigs to only see them as a product rather than as a life, even down to the terminology and process descriptions that are used. The animals aren't necessarily being bred in the best conditions, and as you heard in the section about the production process, they'll typically be slaughtered after about 6 months into their life. On the other hand, they're being used to sustain human life through food and pharmaceutical products. So I'll leave that one up to you and your own ethical compass to decide whether it's right or wrong. In addition to that, the ASF virus itself is catastrophic and is causing a huge amount of suffering. However, we're discussing it as an investing opportunity. If we were seeing an outbreak of the same disease or something similar having a similar effect on humans, we definitely wouldn't be looking at it in the same way.
Jenny's infected! No!
Now, for me, it was quite easy to look at this as just an investment research piece. That was until I came across a video of the diseased piglets being culled, by quite literally being kicked into a ditch, still alive in their dozens, ready to be buried alive. Now, I have to say, this made me look at the situation in a much more real way, and I felt very differently about looking at this as an opportunity. I won't share the video with you, and I won't be preaching to anyone one way or another, but I felt I wouldn't be doing the topic justice if I didn't raise the issue of ethics. So, with that out of the way, let's get back to looking at where the big impacts are. There are winners and losers from this situation from many different angles. From what we've covered in this video so far, you should be able to see where the opportunities are and where there are direct and indirect impacts. But to break it down, here are some key areas you should focus on. In terms of the pig production, you have the producers that are being negatively impacted by having most of their herd wiped out. Then you have the pig producers who are benefiting by meeting the excess demand. You have the pig producers in the US who have produced a huge amount of supply that they can't shift yet, and then other global players who are able to produce overseas and get an edge over their domestic competition. For example, we have Seaboard Corp, which has been one of the major suppliers of pork to China in recent months. Tyson Foods has opened subsidiaries and operations in China, and Hormel Foods also have a Chinese subsidiary. However, although pork does make up a meaningful percentage of their businesses, it's not a large enough dependency that it will completely transform these companies. So it may not be worth investing simply due to ASF. Instead, you'd need to look for smaller companies that are more dependent on the production cycle and are more heavily affected by fluctuations. Then we have the futures prices of lean hogs. In China, they're skyrocketing, but in the US, they're remaining relatively low. Supply in the US is at highs, but there isn't yet the demand. However, once those floodgates open, as there's progress with the trade war, who knows what can happen. Then, if we remind ourselves of the production process, we now know that 70% of the production cost is feed. 1,000 pounds of feed is needed for a 270 pound hog. Usually, you could trade this process by doing something known as the hog crush, by trading the input, soy meal and corn futures, against the output, lean hogs, and using the correct balance and the correct contract months. You can also trade a reverse hog crush if you believe the price relationships differ from historical levels. With that in mind, we know that in China, the hogs are being wiped out and there are fewer farrowings, so this means there is less demand for feed. This obviously has an impact on grain, the grain prices, and on the producers of that grain. But there are also indirect impacts that you may not expect. For example, soybeans are obviously a big part of pig feed, but these are consumed in the form of soybean meal, which is produced by processing the soybeans. A byproduct of this is the soybean oil, which is used for other products such as industrial oils, soaps, and biodiesel. Since there is less demand for soybean meal, with 90% of all soybean meal being used for cattle feed, it means less of it is being produced. This then means that supply of soybean oil is reducing, which will therefore increase prices and cause issues for companies that rely on it. Looking further in the production cycle, if there are fewer farrowings and millions of pigs are getting wiped out, this means there will be fewer hogs reaching the packers. This limited supply will also mean there is shortage for pharmaceuticals companies. In particular, 80% of the global supply of heparin, which we discussed earlier, originates in China. Of course, these companies will adapt and try to find their supply elsewhere outside of China, but China itself will still be with its problems. These issues with pork prices in China have pushed consumer inflation to its highest level in 8 years, showing that this is more than just a pig crisis. Reports suggest that China's pig herd won't recover until 2025, at least 5 years away, and pork imports are likely to peak in 2 years in 2022. Assuming the crisis doesn't spread elsewhere around the world, which it has already shown signs of doing, the recovery should begin next year. This means there could also be opportunities to get involved in this recovery phase as companies begin to regain strength and production heads back towards its usual process. Now, the question you might be wondering is whether my team and I will be getting involved in any of these opportunities. We started this project with the intention of finding opportunities to get involved in, but having got so deep into this research, I find myself reluctant to capitalize on something of this nature. It became very real and crossed the line of what I'm able to do with my trading or investing. But that doesn't make this project a lost cause. Even after well over 10 years of being involved in the financial markets, this project has provided me with so many lessons. It's also reminded me of how interesting it is when you dive into a special opportunities type scenario and find all the different cause-effect relationships. So I hope that you'll find this video useful for your own trading and investing. If you ever want to trade agricultural products, you can refer back to this as a reference point for your research. And of course, as ASF and the trade war appear more and more in the news, you'll know more about what's going on and what the wider impacts are. So for that, why not hit the like button on the video, leave a comment letting me know what you thought, and don't forget to subscribe because we have some absolute beasts of videos coming out. Thanks so much for watching and making it to the end. You're one of the good guys. I'll see you in the next one.